Hello, this is Nick with Tumolo Financial, back again with a monthly Tumolo talk. Today, we're going to go over the types of investment accounts. All I'm going to bring up today is the basics. Basically, what we're going to go over today is how to withdraw from these accounts and what are the tax ramifications on these accounts. Yes, there are some exceptions to these rules. I just want to go over the basics today. The exceptions, what I'm going to say is consult your advisor before you start doing a few of these things, because there will be some exceptions to these rules. So let's get into it, and I'll even go over a few of them to say, okay, if you have these types of accounts, maybe you should look into it. So the first type of account we're going to go over is those tax deferred accounts, those accounts that you haven't paid tax on: IRAs, 401ks, 403bs, 457s. Even you can add in those TSPs and TIAA accounts. They're looked as, with taxes, as ordinary income. So every dollar that comes out is potentially taxed. So that's something where you look at the federal tax code is it's progressive. So it goes from 0 to 10 to 12 to 22, 24, and so on. How much are you pulling out of those accounts, factored in with everything else too, will determine on where you pay, how much you pay in taxes on the federal and on the state side as well. We also know on these types of accounts, there is RMDs, required minimum distributions. That's when you have to take money out. You're required by the IRS to take money out, whether you're 73 or 75, depending on your year of birth. You have to take out of those accounts. The other thing I just want to point out too, if you forget to take out of those accounts, there is a penalty of now 25%. So they cut it back from 50 to 25 now. So they cut it in half. Still a sizable penalty. There is an exception where you can actually write to the IRS, say, I'm sorry, I forgot to take out my RMD this year. Please forgive me and wipe away the penalty. They will sometimes wipe it away the first time if you forget. So there, like I said, there's exceptions to some of these rules. You can take out of these IRAs, 401ks, these tax deferred accounts, usually at 59.5 before getting a 10% penalty. Like I said, once again, exceptions. 457s, you can take prior to 59.5 with a few different rules. And even out of those other types of accounts, there is hardship rules where if money's tight, if there's a terminal illness, another few different factors in there, you can actually take out prior to 59.5 without that 10% penalty. So there is exceptions with the 457, a few extras, but there is also that hardship exception with all tax deferred or retirement accounts. What we like to do is try to think about tax planning to help resolve some of those tax issues, RMDs, possible tax increase later on, because I know that's a big one that people think about. How do we smooth out the taxes? How do we lower taxes throughout a 20, 30-year period so you pay the least amount of taxes as you can? Now going into Roth accounts, we know those accounts, when you take money out, they are tax-free. The exception to the rule is your initial contribution that goes in there had to be 5 years prior to get that tax-free benefit on everything. The money that went in, the interest, the gains, the dividends, everything ends up being tax-free as long as the money has been there for 5 years. Same rules apply as the IRA, where you can take out after 59.5. Same thing with the hardship withdrawals. So I'm not going to go back and talk about that. The other thing I do want to bring up, though, other than the 5-year rule with the contributions, there's also the 5-year rule with the conversions. Roth conversions have a 5-year rule on each conversion you do. So a little bit different than the contributions. Contributions goes by the initial contribution. Conversions go by each conversion that you do has a 5-year rule before you get the full tax-free benefit. So I just want to bring up both of those because, like I said, a lot of exceptions to these rules. Always talk to your financial advisor before you think about doing a few of these tax benefits or even some withdrawal strategies so you can enjoy your retirement. Another type of investment account there is out there is the brokerage or joint account. Some people call it the non-retirement account. You can put as much money in those as you want, whenever you want. You can take out of those accounts whenever you want because there's no 59.5 withdrawal. One of the things you do want to be careful with, though, if you're taking out of these accounts you're withdrawing, that means you're selling off investments. When you sell off investments, there's capital gains Capital gains could be short-term or long-term. When they are short-term capital gain tax rate, that goes by your ordinary income. So same thing as those IRAs and 401ks. Long-term capital gains, so if you held the investment for more than 12 months, if you held, let's say, Apple stock, you have a 0, 15, or 20% taxable income on your capital gains, depending on where you fall on that taxable income. So you just want to make sure to look at these things before you make these decisions, because there's some ways of getting around some of this tax. There's some ways of just lessening the tax. We even look at the end of the year, another thing we bring up is tax harvesting, where you take, I'm going to pick on a couple companies. Let's say Apple did great for the last couple of years. You have $5,000 of gains, but let's say Tesla did bad the last couple of years and has $5,000 of losses. If you sell off both and you match them together, you end up with $0 of taxable gain. So then you match that up. That's called tax harvesting. Then you don't pay taxes on the Apple stock, and you match the Tesla, and you said, you know, I don't want to hold Tesla anymore. Let's match them together. Let's get my taxes down to 0 on the capital gains, and then you don't have to pay tax on that. So you want to look at these things before you end up doing these things to help give you an advantage. Other things I didn't bring up in this situation, because there's other taxable codes, especially when you get in retirement. Social Security is based off provisional income. You also have pensions. I know some people do have pensions. I know they are dying slowly, but pensions do fall in that 401k IRA where it's taxed as ordinary income. So what you're really trying to do in retirement is pay least amount of taxes pulling from those IRAs, those Roths, non-retirement accounts, Social Security. If you bunch them together, you figure out your average taxes. Should I pull this amount from here? This amount from, we know social, you get at a certain amount. Maybe I should pull some from Roth. You're trying to pay the least amount of taxes throughout a 20, 30-year period. Look at these situations. Look what you have for investment accounts. Talk to us. We do a complimentary phone call. Our phone number is 860-650-3005. To go over these situations, we'll build a Tumolo financial retirement checkup to see if you have these tax situations where, okay, maybe you do have a tax advantage that we can enhance your portfolio. Because what you think too is, if I can get a tax benefit from this, that means I can keep more in my investment accounts. And what happens is, when you keep more in your investment accounts, you have compound interest. That money stays in there. You keep getting the gains from the market, and you have more for your lifestyle, or even pass on to your beneficiaries later on. So call us today to set up an appointment. Thank you for listening.